Welcome to Crash Concepts, where the economy, energy, and the environment are explored. Up next, fresh ideas and insights into the factors that are driving the world and shaping your future. Presenting information you can't afford to live without, here's Chris Martenson.
Welcome everyone to this Peak Prosperity Podcast. I am your host, Chris Martenson, and it is March 28th, 2018. Now, in case you haven't been paying close attention, there are warning signs everywhere suddenly emerging, suggesting that the stock and bond markets have finally begun their long-awaited corrections. But have they? Look, we've been here before only to have central bankers ride in with another flood of money that only bought them two things. First, more time. I admit that's worked longer than I ever thought. Second, even larger bubbles in the form of ridiculously high asset prices. As we enter the late stages of the third massive central bank-inspired bubble set, in 15 years, by the way, there are precious few voices that have been steadfastly pointing out all along the way just how idiotic all of this is. And did I say third bubble? I actually meant global interconnected set of bubbles, period, plural here. Today we're going to discuss macroeconomics, real estate, bubble dynamics, debts and deficits with someone I've been reading for years, Wolf Richter, proprietor of wolfstreet.com. Wolf lives in San Francisco. He has over 20 years of C-level operations experience, including turnarounds and a VC-funded startup. He has a BA, an MBA, and an MA, and my subscribers also know him as a regular guest on our Off the Cuff podcast series. Wolf, welcome to the show.
Thanks for having me, Chris.
Well, congratulations on your blog, wolfstreet.com. I see that you're attracting a larger and larger following as well. You should, because your writing and analysis are really first-rate, Wolf.
Thank you. We're having a lot of fun looking at the dynamics out there.
Well, Wolf, I see bubbles everywhere. And I believe, my belief system, that they are central bank driven and inspired. And you heard my intro. Further, I believe that central banks bought time at a terrible cost. The bubbles burst. When they burst, it's going to be massive. Wolf, what are your thoughts here?
Yeah, central banks have one particular feature that almost no one else has, and that is they cannot see bubbles. At least they claim they cannot see bubbles. And even though everybody else can see them, they cannot. And even if they could see them, they say they couldn't do anything about them. So they do their monetary policies without actually looking at the side effects of those. There's people out there that say that bubbles is what central banks are trying to create. I'm not sure that's true. I know that they want to create asset price inflation, but not necessarily bubbles, because bubbles are very dangerous to the financial system, and central banks, as guardians of the financial system, know that. So I don't think they want to create bubbles necessarily, but they certainly don't want to do anything to prick them. Now we're in an environment where we have an everything bubble, and even though there's still a few central bankers out there that say that they can't see the bubbles. Others have now, don't call them bubbles, but they say the prices are elevated, quote unquote. And so they're seeing this. And a lot of the responses from the Fed, I think, are not really about inflation. They're really about trying to avoid an asset bubble getting any bigger, and they're trying to avoid a deflation of that asset bubble that could be very messy for the financial system. So they have been tightening, and they have been tightening despite relatively low inflation or consumer price inflation. So we've had a lot of asset price inflation, and but the consumer price inflation has been as measured by the CPI, or even better yet, by the Fed's preferred measure, PCE, has been relatively low and below target. And so they're really not targeting inflation. I think they're targeting asset prices. They're trying to to put a stop to this, and out of fear that it might bring the financial system down again if this goes any further, because all these assets are leveraged. There's debt behind them, and this leverage is what's risky. So I think the Fed is clearly this time on the side of targeting asset bubbles. And people are worried. If the stock market drops, if the Dow drops 1,000 or 2,000 or 5,000 points, is the Fed going to step in and put a stop to it? And my gut feeling is that no, they won't. They will let this run unless credit freezes up. They're trying to bring these asset prices down somewhat, and so I think that's the environment we're in. We have bubbles everywhere, and now we have central banks trying to somehow save the system with minimum damage.
Well, I know the central banks like to think there's such a thing as a free lunch. They could just print up all this money, get some nice, healthy, tasty asset price inflation, all's going to be good. But, of course, the opposite side, the cost for this lunch was that pension funds were just getting obliterated without having any yield that they could get on safe assets or so-called safe assets on the bond side. So they thundered over. 60% average U.S. pensions are now 60% of their assets are invested in equities. So an equity correction here would be just absolutely devastating. And so people say, oh, yeah, but, Chris, asset price inflation, few the 0.1%, so their stock portfolios go down. What does it really mean? But this would actually hurt the average person who's somehow tied through their local taxing authorities into a public pension, wouldn't it?
Yes, and these pension funds clearly did this with perfect timing, plowing into into stocks, when after that already been rising for years. So they're, like you said, they're heavily involved in stocks, and that they're facing a correction on those, a big one. They're also still involved in bonds, and they're having a dual problem. So the stock prices, they're at risk and they're likely to decline, and that's going to hurt pension funds. But the bond market is also at risk, and the bond prices are declining. And while the yields are going up, the yields that the bonds in the portfolios generate are very low. So the pension funds that have these bonds and they carry them to maturity, these bonds are generating the yields that were in the market a year or 2 or 5 ago. And these are very low yields. They have 10-year treasuries in them that in their portfolio that yield their portfolio 2% or less than that, 1.8%. They may have euro bonds in it that yield a negative rate. And so when yields go up these days, those yields don't change. They're locked in their portfolios. And unless they sell those bonds at a loss and replace them with high yielding instruments, those low yields, they're locked in. So now they're having they're having the losses on the stocks. They're having extremely low yields for the next many years on the bond portfolio. And they've taken on more risk by going into alternative investments such as private equity and so forth. So they've loaded up on risk to deal with this situation, and that's clearly what the central banks wanted, what the Fed wanted. They wanted every investor to go way out on the risk branch, and pension funds have done that. And now the price, as you said, is right here in front of us, and most of these pension funds are state and municipal funds, so taxpayers may be, this was a legal situation that has yet to be worked out, but taxpayers may be at least partially responsible for picking that up. And now corporate pension funds, as we have seen with companies that are going bankrupt, such as Remington, they're guaranteed to some extent by the federal government, and that too in the end is probably going to be the taxpayer that will have to step in.
It's just astonishing, and we've been talking about these bubbles at sort of a macro level. Let's dial in a little bit. I'd like to illustrate this larger bubble in equities, maybe using a single company as an example. So let's talk about Tesla. Now, you just wrote in a recent piece, which was really excellent, by the way, when will investors get tired of feeding their capital into this cash burn machine? Come on, Wolf. Don't you feel the Musk Tesla love? Come on, he's a genius. First, Wolf, what's going on at Tesla? Help paint the picture. And second, how can such things actually occur outside of a bubble? Is that possible? So first things first, what's going on?
Yeah, so let me just say right up front, I love electric cars. And our next car is probably going to be electric. Yep. So this is not about electric cars. This is just about Tesla, the company, and its finances and its operations. And the problem with Tesla is that it's trying to be an automaker, but it cannot manufacture on a mass production scale the cars that it promised it would be able to manufacture. So the Model 3 is just not. It's just not happening. It's coming out in very small volumes. Only the high-end units are being produced right now. It's losing a ton of money on each one of those. Tesla is bleeding so much cash. I mean, this is not a startup company. Tesla's been around for 10 years, and it has thousands of employees, and it's a global. It has global sales, and it is not just some scrappy little startup that's losing money because it's just at the beginning of its life. This is a mature company, and it has already $10 billion in debt. It borrows from its future customers by soliciting these deposits. It owes its customers over $800 million in those deposits. And yesterday Moody's downgraded it, and that was a horrific downgrade all across the board. And it said what I've been saying for a long time, that the debt is actually at risk. And the credit markets think that Tesla, because it has a large stock price, its debt is pretty secure because you can always sell more stocks, more shares, to raise more money and to use that money to service its debt, to pay interest and to pay for its negative cash flow and to pay off its debt when it matures. And so the whole premise of this debt is that the high stock price backs it. And so it's sort of guaranteed by the stock market. Now, Tesla's shares are now down over 30%, and from the peak last August to September, and so there's no guarantee that the stock price would be high enough to guarantee that debt. And when creditors see that, and there's $10 billion in debt out there, when creditors see that, they're likely to get very shy. And Tesla's bonds yesterday plunged. Moody's reported the downgrade in after hours, and that's when the Tesla bonds plunged. Today it was a bloodbath. So creditors are getting worried. The problem with Tesla is it burns $2 or $3 billion a year that it needs to raise, and it needs to raise that money by either selling shares or by selling bonds. And when the markets aren't willing to do that, Tesla's running out of options. Now, it has the Gigafactory. Maybe it can mortgage it, and then it's got $3 billion in cash on its balance sheet. So it's not going to immediately collapse like some people think. It does have some resources, and the stock price is still extremely high at $255 right now, something like that. I think it should be in the single digits, because of the risk that it poses. That if a mature company burns that much cash year after year and relies solely on investor cash to keep going, something needs to happen. And if Tesla stock, if it trades at $10 a share and all the money raising avenues are cut off, then the company will either have to turn its operations around to where it's cash flow positive and self-sustaining, or it will have to just throw in the towel.
Now, so as an equity investor, you talk about this $250 stock price still. It was over 300, well over 300 for a while. I think it hit 380 or something at one point.
Yeah,
but as an equity investor, of course, I'm only interested in participating in the positive earnings of that company going forward. Has Tesla ever made a profit?
No, Tesla has never made a dime. And so
has it been close?
On an annual basis, no. I mean, it's getting worse in terms of GAAP earnings. So that's the accounting measure. And in terms of cash flow, it has lost money every year and in ever larger amounts. And that's the terrible part. As you grow, your initial losses should get smaller. As your revenues get larger, your losses should get smaller, and that's not happening. It's the opposite. The more Tesla sells, the more it loses, and that's a prescription for disaster. And the only reason Tesla has been able to do this is because investors have been incredibly willing to support it.
Yeah.
And Tesla has raised money every year, either via stock sales or via bond sales, and there has been no issue trying to do that. Investors have been incredibly eager to support Tesla in its money burning operations, and when that continues, Tesla can continue just fine. But as soon as investors have second thoughts, that show is over.
Now, bubbles, of course, are fueled by ample credit. Yeah, I can't find any bubbles in history that didn't have easy credit somewhere baked in here. So that is, in banker parlance, we might say easy liquid financial conditions, right? And a good tail. You need that tail. Tesla's got an extraordinary story. Listen, I've loved the Tesla products I've ridden in. I think they're really a really sweet car. But the prices of financial assets and bubbles, they're not rational, right? They're rationalized. So, that means that you need easy credit and a good tail to make this all work. So here's a quote from John Thompson of Velas Capital Management. Just came out yesterday. I thought this captured the Tesla story really well. He said, quote, "As a reality check, Tesla is valued by investors twice as much as Ford, yet Ford made 6 million cars last year at a $7.6 billion profit, while Tesla made 100,000 cars at a $2 billion loss. Further, Ford has $12 billion in cash held for a rainy day fund, while Tesla will likely run out of money in the next 3 months. I've never seen anything so absurd in my career." End quote. Really, there must be an extraordinary rationalizing process in investors there. Doesn't that sort of capture the bubble ethic here?
Yeah, it does, and we see that not just in Tesla, but in many other areas.
Sure.
And so Tesla is not the only company or the only financial situation out there where we see this, and that's true. I mean, that's a bubble mentality where the financial or operational fundamentals are essentially irrelevant. It just doesn't matter. It doesn't matter what happens at Tesla. As long as people believe in the story, it's the story that matters. And the story can be anything. It's just a story. And the reality just doesn't matter. And cheap credit has spawned this attitude. It's fundamental to every bubble. Tesla is more equity finance than credit finance, but it does have quite a bit of debt too. So there is somewhat less of an issue now in terms of cheap credit, but it creates this whole atmosphere where reality just simply doesn't matter. It's the central banks are in charge. They're going to inflate this asset bubble up to eternity. And the only way to play this game is to be fully in and to believe every story out there. And that's a very good indication, I think, at some point that this bubble cannot go on much longer.
Well, it's as I led off in my intro, I think there's plenty of signs to say that the tale, the story, that good yarn has sort of broken here, because if you look across, yes, Tesla is actually down. You mentioned down 30%. It's down 15% in the last 2 days. It's had a rough couple of days. I think it's 8% yesterday, 7% today. But looking out here, I see Netflix stumbling, Facebook, of course. I'd like to talk to you about that. But it feels like the technology sector in general is the bloom might be off of that rose. And of course, the problem for a company like Netflix to extend our story out one layer to another company is that if people start looking at that company and saying, wait a minute, I need to see positive cash flows, boy, there's not only is there not a good story there, there's an actually really bad story there.
Yeah, and Netflix is in a very similar ballpark as Tesla in that it uses its high stock price as a guarantee for the lenders, for the creditors. And when that high stock price sinks, its debt will get in trouble. And it's the debt that causes a company to be pushed into bankruptcy. It's not low sales, it's not a loss, it's when a company can no longer deal with its obligations. And that's what creditors are worried about. And Tesla has been borrowing a huge amount of money, and it continues to do so every year in large amounts. And It's guaranteed to the creditors is, look, we have this gigantic stock price. We can always sell shares to pay you off.
Right.
That's a bubble mentality. You're relying on all these equity investors out there to keep us propped up so that the creditors can sleep in peace.
Yep. Well, it's those, and those two dynamics feed off each other, right? So the more credit that's out there that allows these companies to borrow a lot is also helps the stock prices go up and all of that, particularly if the companies are borrowing money and then buying shares back. So those two pieces can feed off of each other, but of course they can operate in reverse. Now, corporate debt is, I think, at the highest it's ever been. And of course, corporations have been buying shares back, including during that little dip in February. I think they were by far the largest purchasers in that dip right there. Where do you think we are in that corporate buyback cycle? Do you think when do corporations kind of wake up and go, oh, this is a bad idea. Maybe we should not be buying our shares back. Maybe we should be selling our shares.
Yeah, and I think the corporations like to buy it high to push share prices even higher.
Yeah,
and that's one of the reasons they're not the low. They're not trying to be the low bidder. They're trying to be the high bidder out there. Mm-hmm. And so they're really empowered by a bull market. When shares sell off short term, you have that phenomenon we saw during the last sell-off where corporations were just about the only buyer out there. But when it's a longer term deal, when the stock market goes down over the longer term, and corporations think, oh, if we wait another year, we can buy those shares back for a lot less. And we can't really, there's so much volume going on, so much selling going on, the amounts we have available to prop up our own shares are not sufficient right now. We can't stem the tide. And we've seen that during the sell-off in the financial crisis, corporations pulled back. There was no share buybacks really during that period, and very few of them. And it's just kind of fizzled. And they started buying back their own shares later when the bull market had started. There's another factor in that. A lot of times, many companies such as IBM that borrow money to buy back their own shares, they're going to be handicapped by higher interest rates, by higher cost of money. And that's what the Fed is trying to do right now. It's trying to cause the cost of money to rise for corporations. We've already seen that in the high grade bond market, the yields have gone up quite a bit. It's still just the beginning. So the movements have been somewhat timid, but this is going to go on for a few more years. So money is going to get more expensive, and the rationale for borrowing at very low costs to buy back those shares and perhaps save on dividend payments down the road, that rationale doesn't work out anymore, and then that's another reason to stop. So now there's not an issue for Apple or Microsoft or other companies that are using their own cash or that could use their own cash to buy back their own shares. Now, Apple hasn't done that. Apple has borrowed money to buy back their own shares because its cash was supposed to be, overseas. It was invested. It was registered overseas. It was invested in U.S. Financial products, but those were registered overseas, so it couldn't really use those for share buybacks. Now that the new tax law, it can. And so I assume that these companies that have a big pile of cash, that they will use that pile of cash to buy back their own shares. Other companies like IBM that have been big share buyback outfits, they will stop when money gets more expensive. That will just grind to a halt, and IBM has already cut their way back. So I think you'll see the market sort of split in two on this. There'll be the cash-rich companies that might continue for a time longer to buy back their own shares, and there'll be those companies that are borrowing money to buy back their own shares, and they'll stop.
Well, let's talk about one of the more explosive interest rate rises in my chart series, which is the LIBOR, the London Interbank Overnight Rate. LIBOR has really shot up. It's a little, more than 1% in the past year. So, by my, I know, Wolf, that tens of trillions of dollars of loans are linked to LIBOR. And in particular, in the small cap stock space, I think they've got just, huge amounts of loans that are like 35% of them are actually tied into LIBOR. By my math, if there's $1 trillion outstanding in loans on LIBOR and those are 1% more expensive in interest costs, that's 10 billion of cash flow that's diverted into interest payments. So 10 trillion of loans would be 100 billion of diverted cash flow. Do you think is LIBOR getting to a point now where we should consider that a serious headwind, at least in the sectors that are exposed?
Yeah, I mean that's the general rule with rising short-term interest rates, and the Fed has only raised its target range to 1.5 and 1.75%. So this is really still very low. Historically speaking, so LIBOR is a little bit above that. LIBOR right now, the 3-month dollar LIBOR rate is around 2.25%, I think, last time I checked. And so that is higher, but it's still very low. And so when we compare it historically, the interest payments are going to be lower still than they were many years ago, but they're going to be much higher than they were in recent years. And that is a headwind, and the way I think we need to look at it is sort of a quote unquote normalization. These highly indebted companies have gotten a free ride for so long, for so many years, and that free ride is ending. And it's ending gradually. So the LIBOR at 2.25%, we need to look at what it will look like at 4%.
Yep.
That's I think what that's where we'll head by sometime 2019, and maybe higher even. So this is a slow moving process, and it's just the beginning of it. So if these additional interest payments that are based on floating rate debt are already troublesome, what are we going to see in 2019?
Right.
Yeah. So but this is just the beginning. This is just started. We forgot. After almost a decade of zero interest rate policy, we don't know anymore what it's like to look at many years of rising interest rates. And that's exactly it. Money will get a lot more expensive for a lot of companies, and those that have to roll over that, even if they're not on LIBOR, if they have fixed rate debt, they'll have to roll that over eventually. And when they roll that over, they go from a 4% coupon to maybe 6% or 7% or 8% coupon.
Right, and that brings to mind the Hemingway quote. When he was asked how he went broke, he replied, "Slowly, then all at once."
Yeah.
Right. So that's going to be, in these headwinds, I'm expecting to start to see that we're going to start to see some of these smaller companies in particular start to go poof, right, as they go broke all at once, and because they simply can't afford things. And this is where I think about the ridiculous low yields in Europe in particular, looking at their junk rated debt. As of last summer, was way below the rate for a 10-year treasury in the U.S. market. They had a just under 2% rate on junk debt. There's no possible way you can normalize rates without somebody taking just an exceptional loss on that junk debt at this point.
Yeah, and that's a tragedy waiting to happen for pension funds, not just in Europe, but in the U.S. as well, because the American investment community is heavily focused on its global assets, and so our pension funds have a lot of euro debt in it, and so these bonds that they and the only hope is that when you're an American investor, that you will make some money on the exchange rate, but that might not be the case either, and so we're back to that problem where these pension funds are chock full with bonds that have either no yield or very small yields or a negative yield, and unless they sell them, these yields stay the same, for the next few years. And that's just, I mean, that was completely nuts, going to negative interest rates, and even the Fed has seen that, and the Fed has said many times that they don't want to do that. Watching what the ECB has done. That is just, I mean, there will be, we will see the results. They will be obvious, and it will teach central banks a lesson to not ever do that again. That was really, I mean,
we can hope.
Yeah, I mean, when you listen to the Fed governors discuss negative interest rates, they just dislike that with a passion, and it is just it is incredibly risky, and it moves so much wealth from the future to the present, and creates this current paper wealth that then evaporates, and it redistributes the wealth, and in so many bizarre ways. That it's just going to turn out bad. Negative interest rates. This is just going to be a nightmare down the road.
Yeah, and of course it has to. And everybody's thinking that the central banks can sort of pull another rabbit out of the hat and to infinity and beyond and keep inflating stuff. But as you mentioned, the mood right now is that they've all publicly committed to not doing that at this point. They're all committed to winding down. And so people are thinking more vocally that, well, it might take an exogenous shock, some sort of a war. But let's talk about trade wars. Is that possible shock? First, what do you make of these trade wars? There were really two very powerful down days last week and the week before this recording, with Thursday, Friday, Dow was off by, I think, 700 points one day and maybe 400 the next. And the explanation given, I'm opening up my newspaper the next morning and it was trade war with China. That was the cause. What do you think of that?
Yeah, I think the explanations are media savvy statements. I think the stock market is really ripe for picking, and everything is overvalued. There doesn't need to be a trigger. These things, they're so ripe for a big sell-off, and there doesn't need to be anything that triggers it. It just happens on its own. Now, a trade war can be a really nasty thing, and on the other hand, the United States has an extremely out-of-whack trade relationship with China. And when we say China, we actually need to say China/corporate America, because those two entities are largely responsible for that. Mm-hmm. And so that trade war then also targets corporate America. And at the same time, corporate America is responsible in large part for the enormous trade deficits we've had, and these trade deficits are not sustainable. This is something that needs to be addressed. So I'm glad Trump actually puts it on the table. I've been writing about trade for years, and it's ignored. People just don't really care about the trade deficit. And so suddenly Trump comes along and says, yeah, this is a problem, and we do need to do something about it. And we're not going to just have tea with the Chinese and with corporate America, but we're actually going to we're going to rattle some chains here. And we're going to put our foot down and try to get people to think about this seriously. So I think there's some good to that, and long term. And I think the media likes to blame any sell-off for something like that. But we got to remember, in a bull market, the market climbs a wall of worry. That's what everybody says. There's in a bull market, bad news is good news. Stock markets climb on bad news. In a bear market, or when things turn around, that's no longer the case. And so you really don't want to tie the news necessarily to the market movement, because in a bull market, the market goes up no matter what. And we had a transportation recession in 2015, 2016. We had all kinds of issues. GDP in 2016 was way low, and the market just surged. And the market surged 30% since Trump was elected. I mean, these are incredible melt-ups, and despite whatever news there might be, so I don't know that I would want to connect headlines to the sell-offs. I do think that trade war, if a real trade war breaks out, which I doubt, I think this will be negotiated on all sides very vigorously, and I don't think there will be a tit for tat trade war that will blow up the global economy. But I think there will be losers and there will be winners, and some of the losers will be among corporate America, and some consumer prices may go up a little bit, even though I doubt that since the actual prices that we have in a lot of these products like the iPhone, the costs are fairly minimal. Most of the iPhone's price is Apple profit. So
Right.
when you look at Apple's gross margins, if the iPhone costs a few bucks more because it's made in the United States or because there's a tariff on something, it's not going to change necessarily the price in the US of the iPhone. It's just going to take a tiny little sliver out of Apple's profit. So I'm not too worried about that trade war. I am seeing the stock markets declining regardless of what the news is.
Right. I was just a little irked myself where, that 30% gain you talked about since Trump was elected was largely credited to the idea that the stock market's forward looking and it saw the tax breaks for corporations coming and it was pricing that in. And then, now I'm opening the newspaper about the trade wars, and apparently the stock market didn't see that coming when Trump has been really consistent about everything that he's sort of said he was going to do on economically. I think he's been pretty true to so far.
Yeah, he stuck to his guns. The trade war was part of his campaign just as much as the tax cuts. And, NAFTA renegotiations have been going on for a month. People who are worried about a trade war today should have looked at that, and say, yeah, he's serious.
Yep.
NAFTA was sacrosanct. You didn't touch it. Nobody did. And suddenly here he is, threatening to call it off and starting to renegotiate it. And that started last year sometime. And they've been doing that for months. And so there's no surprise in this. I mean, the trade war rhetoric has been out there from the Trump campaign since 2016. So yeah, you said it perfectly. I mean, there's no surprise. The stock market should have priced it in, just like it priced in the tax cuts. And so I think it was just a media savvy way of explaining a sell-off.
Sure.
Yeah, everybody jumped on that trade war excuse. Nobody really wants to say in the media that the stock market is way overpriced and it needs to sell off. That we have an asset bubble and it needs to come down. I mean, that's a hard thing to say.
Right. Well, my headline would have been, bubbles are always in search of a pin. So
that's right.
if the pin was the trade war suddenly emerging, unexpectedly, fine. It really doesn't matter. As you said, look, when things are this overpriced, often it doesn't matter that the reason they start going down is valid or not. It just starts happening, and then we try to make headlines that sort of explain something. I guess that's what journalists try and do. So, hey, while I have you, because bubbles do tend to burst in series, stocks burst, then real estate, for example, especially like in key areas like California that are most exposed to equity gains as drivers of housing prices. Recently, there have been some notable rollovers in sales volumes, couple key bubble markets, Toronto and New York, just to name a couple. First, where are we in terms of the prior housing market bubble peak nationally in the United States? Then, riffing off of a recent article title of yours, let's pick out a few splendid markets to focus on.
Yeah, so in terms of every housing markets are hard to measure. So let me just give this caveat up front. So there are different ways of measuring it, and no measurement is perfect. So this is now based on the Case-Shiller Index and the data they provide. This data is based on price changes between sales pairs. So the same house sold in 2011 and then it sold again in 2018. And so they use that price change and they have an algorithm to make that work, and they have a 3-month rolling average. So that number that you're getting is delayed, and so what we're looking at today are the price changes late last year, and they're rolling 3-month average changes, so they're smoothing out that way. So that's a long caveat, but every measure shows very different numbers, so that's why I need to put that out. And the Case-Shiller is one of the best measures, perhaps long term, to look at this, even though it is a little bit behind, and it doesn't show the month to month quirks of the market very well, but it does show the long term situation very well. And so on a nationwide basis, the index is now over 6% above the prior housing bubble peak. And that means that in some cities, the prices are still below the prior housing market peak. And in some cities, those prices are way, way, way above. And we got to remember that the prior housing bubble peak wasn't some sort of state of calm, some sort of place to return to. This was the moment when things collapsed. So this is not exactly the best place to aspire to be. Now, we've had price inflation and wage inflation and other things in the market, so it is not 100% comparable, but we'll look at it this way. So in Boston, for example, the Boston market, according to the Case-Shiller, is now up almost 13% from the prior peak, and the prior peak in 2006. Boston has seen some declines in recent months, so actually the gains have stopped, and for the last half year or so, it's sort of been flat in terms of the price gains. It is one of the more expensive markets in the country, and it's sort of run into a ceiling at this point. Seattle is probably one of the hotter markets out there. It is now 22% above the bubble peak, and it had a huge bubble peak. I mean, when you look at the chart, the way the housing bubble one, as I call it, the way it surged was just incredible, and it has now even outdone that. Prices now 22% higher than that. Consumer price inflation measured by the CPI over the period is less than 22%, so it's like around 18%. So even on an inflation-adjusted basis, Seattle home prices are now quite a bit above the prior bubble peaks. And Seattle has a huge building boom, maybe the biggest building boom in the country right now. And it's all high-end, it's all multi-family, so apartments and condos. And there's no shortage of supply. There's a lot of shortage of affordable supply, but not general supply. These new units that are coming on the market, they don't show up in any of these figures because they haven't been sold yet. They don't even show up in the median price figures because that the multiple listing services issues, because they're not sold to the multiple listing services through brokers. They're sold directly by the developers. So these new units are not showing up in the data, and there's tens of thousands of them waiting to be sold or rented out, and new ones all the time, and we're not able to capture them very realistically. So the numbers we're looking at on a town with a big building boom like Seattle are actually not reflecting reality. The reality is we have developers sitting on thousands of units that they need to sell and that they need to rent out, and and they might. In terms of the sales, they might try to hold off, wait for better price. In terms of the rents, and Seattle rents are starting to come under pressure because developers need to fill these buildings. So the building boom cities are not fully reflected in the numbers that we're seeing. Now, Denver's got one of the most gigantic home surges I've ever seen. So since their peak of the housing bubble one, prices have now surged 46%.
Wow. Above the prior peak.
above the prior peak. So this is not from low to high. This is from high to high. And I know some people live in Denver, and they say it's just completely nuts what's going on there. Now, Dallas.
As you and I talked about, Denver, the response in Colorado has been for a call to help subsidize people's rents there rather than asking for the rents to normalize to what the market can bear. Because a bubble exists when prices rise beyond what incomes can sustain. So I'd love to, this whole idea that we're rationalizers, not rational and all of that. As I troll through the various real estate blogs, including in yours, I see in the comments, people run through the usual litany. They're not making any more land anymore. There's a big shortage of these things. Prices will always go up because that's what they have to do. But they're out. They are no longer affordable, even remotely, particularly by the generation that's coming along, that the millennials that presumably would be buying them, is where in what you're seeing, Wolf, what's the connection between prices and incomes at this point in time? Because that's ultimately the only thing that really drives real estate is jobs.
Yeah, so in a city like San Francisco, where home prices are just completely nuts, you only have like 500 sales a month. So it only takes 500 people or 500 households to keep the market going for a while. So if you can bring in 500 households, with enough money to keep the market going, you can. And so that's why markets like that keep going, because it doesn't take all that many people to do. It's not like stocks where you have a lot of volume. And so this is amazing. They'll have these. They'll try to stir up bidding frenzies, and they'll have the same 500 people bid on on the houses that are available for sale. And in San Francisco, everything that's been built in the last decades is multifamily. So nobody's built a single family home in San Francisco in a long, long time. So what the prices that have really surged is single family homes. And that is limited, and there are no more new homes, single-family homes built. The condos have already run into trouble, and apartment rents are already down. So the market is starting to exert pressure here in San Francisco. And it's just started. The high end in San Francisco that you're talking about, just a few units, and so it can do really bizarre things. But we have seen some real problems in the high end because so many high end condos are coming on the market, and there really isn't that demand. And that's I've seen some scary charts on that. These condos that sell for $2, $3, $4, $5 million, and there are a lot of them, and they're coming on the market, and they're not showing up in the actual real estate figures because they're sold directly by the developers. So you don't really know how many there are, but people going around counting, and so it's a worrisome development. So far, the prices. The overall prices have not come down, have gone up in San Francisco, largely because of the explosion of prices in single-family houses. But a majority of the market in San Francisco is condos, and they're under pressure. So the market will eventually work this out. And you mentioned the stock market. California, and particularly Silicon Valley and San Francisco, are incredibly dependent on the stock market and for income. And the state is for revenues. So a major decline in the stock market will have a major impact. Everything else being equal, will have a major impact on the housing market in San Francisco and in Silicon Valley all around. Because suddenly that perceived wealth disappears. And people thought the stock was worth $1 million, and now it's worth $250,000 or nothing. And during the dot-com bubble, after the dot-com bubble, the Nasdaq went down 78%. 78%. A lot of companies just disappeared.
And worse, a lot of people got caught because they were a lot of their gains, their wealth was in stock options, so they would vest their options. You vest your option out at your internet companies at $200, so you vest in, and then it drops to $50. Well, you still owe the taxes.
Yeah.
on what you vested at and the gains you had on that, not what it was worth when you sold it. That's just it really caught a lot of people in a very punishing situation.
Yeah, I did, and yeah, this is a scenario that is much denied now, but it is likely to happen again, and there are a lot more people now on stock options today than there were back then, and prices are further inflated, and yeah, this is something that the whole Bay Area is. We're not oblivious to it. This happens every time, So it is not something that surprises people that have been here for a while. This is just how it happens. And then San Francisco will empty out. People can't afford to live here anymore, and they leave. They go back home, And this happened before, and this happens in Silicon Valley too. And suddenly these high-end condos, there won't be any buyers for them. And so this is something that is largely triggered by the stock market. Even if everything else stays the same, a major decline in the stock market, even if the economy holds up, will have a really strong impact on the situation here in California.
So, well, probably one of the most common questions I get asked is around this decision to buy real estate or not, particularly people who've been watching the bubble dynamic, or millennials who are just sort of biting their nails, wondering if they should just, hold their nose and take the plunge. But so if looking at where we are in this overall story, if you were giving advice, would you advise somebody to wait or to buy, or how would you go about making that decision yourself in terms of real estate?
So if that person is a first-time home buyer, I would definitely need to know where they're located. Mm-hmm. Because some markets are okay, in some markets it's perfectly all right to buy. And in other markets, like in San Francisco, you would be nuts to buy. And I mean, California is a no-recourse state. So, you can walk away from your mortgage without penalties from your purchase mortgage. So if you want to take that risk, and don't put a lot of money down, and if the property plunges in price, you can walk away from it and let the bank take the loss. California is one of like 12 states that have that are non-recourse. The remaining states, the banks can go after you. So that's not recommended, and it's not recommended in general. But it is an exit clause here in California. But the prices are ludicrously high here. I mean, you're looking at a basic condo over $1 million. I mean, there's a basic condo, nothing, a one-bedroom condo, So I would say, at the same time, if you have to live in San Francisco, you're paying rent. You're paying a lot of rent too. But now you can make deals, and rents are coming down, so they might be cheaper next year. And so, yeah, I would definitely. I wouldn't be a buyer in San Francisco at these prices. That's for sure. All right. In other cities, you may be okay, and it would really depend on the local real estate market.
Yeah, but if you look through these. The charts that you have in that article, based on the case Schiller, you can see a lot of places have just gone really, really hot. Yeah. And for those to remain that way, mortgage rates can't climb. And I think we're still at the slow motion stage of this, where that 1% roughly rise in the 30-year mortgage I think that it's going to take a little while to see that sort of bleed through into the actual statistics, but that's got to be hitting people, because, if you could afford $1 million at 3%, there's no way you could afford it at 4% possibly, or 5%, depending on where mortgage rates are at the time. So that's obviously sand in the transmission of this story, isn't it?
Yes, that is true, and we have seen even today, pending home sales came out, and it's always so funny when the media reports on it. They say pending home sales rose. Yeah, they rose from January, but they always rise from January. Pending home sales were down 4% from February a year ago. So, and they were down in January. They were down 7% from a year ago. So, pending home sales are a measure of activity in the market. It's not very accurate, but it's kind of an indication. Volume sale in general, volume has been dropping, and people blame the low availability of inventory, but that's the same phenomenon we've had before the last housing bubble. There was nothing available. There were bidding wars going on, and the same 500 people were bidding on the same 200 houses, and you had these bidding wars. And then when house prices started to decline, suddenly the inventory started showing up on the market because people stopped gambling with it and they tried to get rid of those vacant homes. And suddenly there was this, just when buyers started disappearing, this flood of inventory came on the market. And so I'm not buying this excuse that there's nothing available, that there's a housing shortage. There is a huge supply of high-end housing. We know that. There's a shortage of affordable houses simply because prices have risen so much. We've had this housing bubble going on now for a few years, so that has taken reasonably priced homes way up the scale to where they're no longer affordable for a lot of people. So, and that inventory, that shadow inventory that's out there, that will hit the market as soon as we have some major price declines. So. I don't. This just fits the pattern. What I see today fits the pattern.
The pattern we saw in 2006 and 7, right?
Yeah, exactly. Yeah.
Yeah, and of course that would fit with a larger pattern, which is that where in 2007, if you repeat the larger pattern, everything seemed to be going along swimmingly. The economic growth was okay, and we saw reasonable gains here and there, and unemployment was low. Those all kinds of things were sort of right, but that's always when things go wrong, is when they're at their most right, and vice versa. When things are at their most wrong, they begin to go right again. So this is a really long, strange bull market in asset prices, inspired by central banks, and it's just absolutely astonishing to have witnessed. I'm of the mind that it feels like we could be rolling over here. What do you think?
Yeah, the one thing that I think is going to be very different is last time it happened fairly quickly, and things sort of plunged, and also the Fed was raising rates very quickly going into it. This time, everything, as you said, is slow motion. So we have 4 teeny-weeny little rate hikes maybe this year, maybe another 4 next year. We had 3 last year. I mean, the Fed used to do that in a few months. Yep. They used to do 100 basis points in one sitting. So now they're stretching this out, and there's so much liquidity out in the market that it will take a long time to dry up. And you mentioned LIBOR, it's come up, but it's come up very slowly. It's taking it 2 years to come up this far. It is not like it spiked, in a 3-week period like that. Everything, and it shocks us because we're not used to rates going up, so something goes up a little bit, we're kind of shocked. Now, where does that come from? But it's slow motion. Everything is slow motion. And so I think what we'll see is not a dramatic sell-off of the double-digit percentages that we had last time. I think we'll see a long, drawn-out, much more difficult process. And at first, it won't even look like a sell-off. I think in housing on a national basis, housing will continue to look strong, even though the sell-off will start in particular cities. And so you will have some cities that are turning around, but overall, nationwide, the numbers are still stable. And so the Fed won't even be worried about it because they're looking at the nationwide numbers and they're saying, it's still okay, or it's just declining a little bit, or it's plateauing, whereas house prices may be coming down pretty sharply in some of the most bubbly cities.
Well, very well said. And Wolf, that's all the time we have for today. I could talk with you for hours about all of this, but thank you so much for your time today.
Well, thank you, Chris.
And people can follow you at wolfstreet.com, also at Twitter, which is at Wolf of Wolf Street, spelled ST, Wolf of Wolf ST. I have that correct?
Yes, you do. And it's easier just to go to wolfstreet.com. That's where everything is.
That's where everything is, of course. Well, again, hey, thanks a lot.
Thank you.